This really is an opportunity that many people are probably overlooking right now, and I don't think that's a good thing. I'm about to show you a part of the conversation that I had with Andy from Finding Value from the YouTube channel this weekend, where we talked about his general understanding and outlook of the on the market, and he's specifically concerned with the shortages that we are witnessing right now, but even more so concerned with the shortages that we are about to witness if this keeps going like it has, which it probably will. And he thinks that this is the exact thing that is going to cause a lot of inflation, but with little to no GDP growth. And so that makes him bullish on a lot of stuff like commodities. So he likes oil and uranium a lot. But he also told me about the stuff that have to bring those commodities around, like think oil tankers and dry shipping. And so in what you're about to watch, we talked about that as well and many other things. And we talked about what the risks to this thesis are too, by the way, because there are risks, obviously. Now, I had Andy for the weekly video newsletter or whatever you want to call that thing. It's a video that I publish on resourcetalks.com every week, and I'll take the chance to shamelessly promote that newsletter in here. So if you want me to send you an email every week when I publish that weekly thing, because that's not on YouTube, it's only on the website. If you want me to send you an email, you can subscribe by visiting resourcetalks.com. It's completely free, by the way, and I'll only send you one email per week, so I won't spam you. But with that aside, let's hear what Andy had to say.
If you want the max leverage, I think uranium's very good because you've got the ratio that's very low. The ratio can compress against other assets dramatically, which means that the potential there is probably one of the best. Then you've got other commodities that are kind of in different areas of where they've progressed. So oil's kind of the leader, and that's already sucked up some value. Actually, I can show you. There's gold to oil ratio. So gold to oil ratio is at 19. And if you look at the big picture view of that ratio, we were at like no man's land in 2020. So when this ratio was basically signaling a buy point, you could have bought all those assets for pennies on the dollar. And now the ratio is compressing, and we're even compressing below this lower rail, which means that valuation is becoming more expensive against other assets. So oil is becoming less attractive over time as that valuation makes headway against other things. So oil, I would say, is becoming more fairly valued. A fair value is about a 15-to-1 ratio. We're at about 18 or 19. So oil, I would say, it's still great. It still has good value, but the valuation has run some of its course. So what you do next in the commodity bull market is you look around and say, okay, what else is cheap at this current time? Silver and platinum are still cheap. Those are very good. We'll call it good assets right now. They usually perform well at the end of a commodity bull market. They'll kind of like raise their hand in the beginning of the bull market. They'll kind of go sideways, and then they do very well at the end of the bull market, usually like middle to end. Then uranium was kind of like a mid-star performer. Last time it started kind of in the middle of the bull market and also ended kind of before the rest of the crew. I think that's probably going to happen just the same. So it's still cheap. It has a lot of potential. So that's one of my favorites. Shipping is also one of my favorites because it's still very low, and the dynamics in the shipping area also look very, very good. So if you look at the Baltic Dry Index, we've got this huge resistance support level that's held for many, many years going across here. Every time we hit it, we kind of bounce back. Well, this time we broke through it quite dramatically to the upside in 2021. And then we came back and did kind of a retest to that support level. So the Baltic Dry Index, to me, we'll do the weekly charts. The Baltic Dry Index looks like it's ready to move on up. And I think there's a fundamental case to support it too, as commodity prices get more expensive. Shipping companies, if there's a shortage in shipping companies, can charge more money because the commodity prices have gone up so much. So they make money based off the tightness of shipping. The Baltic Dry Index, we'll call it the dry bulk shipping, hasn't been building a bunch of new ships. Their order books are at record lows. So I think there's the possibility with shipping and dry bulk, especially in tankers, those two, to get in a pretty tight scenario where prices really start to go up. And we're seeing it in the Baltic Dry Index. The Russian sanctions also are going to put a whole bunch of pressure on shipping. So not only do we have a commodity bull market that's going to allow the shippers to charge more money with the prices going up with the commodities, we also, if we're in a super cycle in commodities, which I think we probably are based off of the deficits that are ahead of us, we're also going to ship more volume. And if you have order books at record lows and you've got ships being scrapped, I think that there's going to be a big amount of tightening in terms of shipping, and then the rates going on up because of the tightening of ships, meaning it's a tight market to find a ship to ship stuff with. And if we are changing shipping patterns, so to speak, if we're not going to ship things from Russia to somewhere else that's very close, and we're going to have to ship this across the world, I think it's going to make that even tighter. So I think there could potentially be a squeeze in shipping. And I think that the shippers, if you do like a Baltic Dry Index to gold ratio, it is super cheap. And if you were to get back into this kind of megaphone pattern, I mean, we could go all the way to 14. What that means is that the Baltic Dry Index could outperform gold by 14 times. And I'm not claiming that that's what's going to happen. What I'm saying is the potential is there. And the setup that's coming with the Russian sanctions and everything means that the setup exists. And with that setup, I think it's good to allocate some money towards the shipping sector.
Okay, but so it is. So you're okay with that's what I wanted to ask. You're okay with the shipping companies because inflation would also rise their costs, rising oil prices would also rise their costs, and I wanted to ask like which companies you're focusing on that you think are going to be hurt the least from that.
Shipping is going to make more money based off of the commodity itself. So if commodity prices go up, they can charge more money and take more money of that commodity increase from the person who's shipping, because they're going to have to ship this stuff around. They're going to have to get money somehow, the commodity companies, and you're going to have to go through the shipping company. So they're going to be in a power of position, because if you have what we'll call it a shortage of ships, and everybody wants to ship stuff at higher volumes, you're going to pay whatever you can to get this ship to wherever you want it to go. And especially if it's something that's of high need, like food or energy. And a lot of these in dry bulk, they're shipping like coal, they're shipping grain, they're shipping fertilizer, whatever it is. And if we have a tightness and this stuff has to get to different areas through different routes, I think that those routes are way less efficient. So not only do you have a tightness in ships that you want to ship more, they're going to be on the water longer doing these more inefficient routes. So I just think that there's going to be a huge tightness there. And the way that I'd play it is through the shipping companies themselves, because one, they're completely undervalued. Their incomes are going up and their revenues are going up. And some of these companies have incomes in a year that are the size of their market cap. So their PE is like 1. It's like, or less than 1. And I'm just like, oh my goodness, this is ridiculous. So I think there's a lot of value there. And the potential squeeze hasn't even happened yet. It's just starting. So yeah, I'm big into physical metals. And the reason I like the physical metals is because the mining companies are kind of playing a different tune. You're not just using more energy to extract, or the energy is more costly. You're also going after lower and lower ore grades, which takes exponentially more energy use. So as your ore grades decline over time, and your input costs of fuel is going to go up at the same time that fuel is increasing. So I'm not a huge bull on the mining companies themselves, especially the really small ones who don't have the infrastructure in place yet. So I've kind of shied away from the junior gold and silver mining companies more so, and I've gone more towards stuff that has infrastructure in place already. So when we look out in the future, and we've seen tightness in markets here. What I mean by tightness, like if you were to look at Monster Energy, and I know that's not commodity, but they're struggling to obtain aluminum for their cans. And we're going to start seeing, I think, shortages of and supply chain problems with a whole bunch of different things out in different areas. So it could be aluminum, zinc, copper, and this is I'm looking more like 5 to 10 years out. And if we have these shortages all over the place, I think the complex assemblies, the complex things are going to be more difficult to obtain and run. So I think those things that have current minerals and energy already sunk into products or infrastructure that they have will become infinitely valuable. So I've been looking at it from that perspective. And if you have a ship shortage and at the same time you have a commodity shortage, how do you build new ships? You know, and how expensive are they going to be? So it's not just, hey, we're going to build a ship and this thing's ultra valuable. Everything that exists currently is going to become ultra valuable. So I've been going after the companies that have a lot of ships that are very cheap, because if we get into a tightness of the market where we want, you know, all of this stuff and we're changing the shipping routes, I just think there's going to be a tightness and there's going to be a difficult time to fix the problem, the root cause of the problem, which is not enough ships at that time. So that's the shipping aspect on it, and why I like shipping.
I used to be in shipping in my, gosh, I was really awful back then. I still am, but like when in March 2020, when the oil price dropped to below zero and they were stuffing oil tankers with oil, putting them up on sea. I used to be in some of these companies like Euronav. It's a Belgian company. And I remember a part of it, I haven't looked into shipping ever since, but I remember a part of the thesis was also that oil tankers specifically were not ordering any new ships because there were going to be new environmental regulations or whatever, that they weren't sure as to how are those going to develop. Like in 2030, I believe they drop. What are those, the IMO regulations or something along those lines? And so they're not building new ships because they don't know exactly which ships they have to build, and like which CEO is going to buy new ships blindly if they have to. Those are ships with lifespans of like oftentimes 20 to 25 years. They're not going to buy new ships in 2022 and just throw them out in like 8 years. But in the same time, what you mentioned was also a very interesting part of the thesis, rising like iron ore prices and steel prices. Those ships are made of steel. When they're done and they're no longer commercial, that steel is still, well, you know, steel. So you can recycle it, and they can actually end up making more money off the ships than what they paid. That was part of the thesis. Is that still a thing? Like, is it realistic?
Yeah, there's people scrapping them for very good money. And the thing that I look at is what is preventing stuff from coming into the market, and then you've got what's going out. So when these ships get old, yeah, they're scrapping them, they're getting a bunch of money for it. And then as steel prices go up and as iron prices go up, all that stuff, your cost to build new ones is going to go astronomically high. And if we can't ship this stuff around the world, I mean, how are you going to do all of it? I mean, that's the question. And the order book is at record lows. I mean, it is way down there for dry bulk shipping. And what they're doing is they're putting sanctions on Russia and saying, hey, we're going to ship this stuff all around. It's like, you don't have the capacity to ship all this around. Then it becomes price. Oh, what do you want to pay for it? So I think that's the setup there in shipping. And shipping is the thing that I've been buying here recently, just because it's down. And I think that this dynamic could happen over the next, 4, 5, 6 years. I'm looking at stuff that's long term. I'm not looking at the short term things. And keep in mind, like when I say a ship or whatever has sunk minerals and energy in it to build it, and then think of like the cars, automobiles. We had a chip shortage in automobiles. It was one shortage of a complex assembly, and what happened to used car prices? They went through the roof. It's the same thing that's going to happen to shipping. It's the same thing that's going to happen to all of these things that have sunk minerals and energy and infrastructure in place. They're going to become a lot more valuable. And I think that's going to happen in absolutely everything. So things that are above ground and in your hands are going to become a lot more valuable than stuff that's stuck in the ground. if we get into shortages of that, we'll say of that size.
Mm-hmm. And
So yep.
no, go ahead. Go ahead. Go ahead.
Yeah. So I'm just looking at things a little bit differently than maybe some other people, because I think the shortages, if you look out in 2023, 2024, 2025, that's when a lot of shortages happen. And when you look at kind of the way the world is positioning, so I'm looking kind of like how they're positioning in a chess game, so to speak, is they are positioning for this renewable world. They're saying we're going to do electric vehicles, we're going to have renewables, we're going to have all this stuff. My question is, what if they don't have the minerals to do it? What if they don't have that amount of minerals with the shipping capacity, whatever it is, to do that? So anything that's existing already, it could be cars, it could be anything that has sunk minerals already into it, is going to become ultra valuable in a world that looks like that. Because what's going to happen is you're going to get shortages in like 15 or 16 or 20 different things all at the same time. And it's going to require massive amounts of investment simultaneously. And I just don't know how they're going to do that. You're talking like, this is going to be massive amounts of money. So the way that I'm seeing this, and the way that I kind of looked at the ratios, is the last 12 years, everyone has positioned a lot of money into bonds and stocks. They've positioned it all over there.
I mean, bonds
All
went
of
up
this
for the last like 40 years. I think that most big money managers were not investing when we had declining bond prices. When there were decline, I was not even born, obviously. But so, most people who are investing right now don't even remember falling bond prices. All that they've known is rising bond prices, and they were relatively safe with a relatively low counterparty risk. So why not buy bonds? But that's changing too. So that's an interesting dynamic as well.
Yeah, so all the money rotated over there. We can see it in the ratios. It's all over there in stocks and bonds. In an inflationary environment with increasing interest rates, bond prices go down. And if you were to see that, and I'll show you it just to show you what the bond prices are doing, now we're going to start to make a lower low. That's what we want to watch for. This guy breaking out puts us into a basically a downtrend here. But the first step is to break this uptrend line. We've broken that. I think we're probably going to maybe come down and head back up and do like a return move or something. And then we'll see if it rolls back over, which I suspect would happen with an increasing interest rate environment. If that happens, that money's going to rotate out of here. It's already rotating out. I'm talking like big money's rotating out at that point if it goes into a downtrend, because people will be losing money in their bonds. They're going to get scared. They're going to say, get my money out of here. And this will kick off basically a feedback loop where money goes into commodities, it raises the inflation price, and then people sell their bonds, and it just rotates back and forth in this loop. So what I think is going to happen, and I'll just kind of try to describe it as high level as I can. When you're in a world of excesses, when you've got an excess of everything, people start to speculate on stuff they don't need. So they'll speculate on something like Bitcoin or crypto or whatever. They'll speculate on anything, NFTs. Now, when the things that you need in life and in order to live start to become scarce, all of that money is going to rotate out and go back to the things that people need in order to survive. So what I think is going to happen, and I know this might be a little bit extreme, but you can see that bonds are starting to sell off. You can see that stocks will start to sell off. I think the cryptos and all that other area that people were speculating on with a commodity surplus, I think all that's going to unwind, and it's going to go and get redirected towards living in houses, in rent, in food, in commodities. It's all going to rotate back over, because when somebody wants a car, if they want to drive around and they want to buy a new car, and you're short graphite, you're short rare earth metals, you're short lithium, you're short cobalt, all of these things have to be developed, and a whole bunch of money needs to be sunk into these minerals in order to get to where people want to live, the lifestyle that they want to live. So I think that based off of the inflation, which comes from the housing market, based off of interest rates, it's going to rotate all that money back over. And based off the wants and needs and the lifestyles that people want to live. And that's going to require far more energy worldwide. It's going to require far more minerals. So the way that I'm playing it is, I think this all stems from basically an energy shortage. That's kind of what it stems from. And and that's going to have tertiary effects all over the world that we're seeing. Those tertiary effects will be, fertilizer prices going up. And then there's other things that we don't know that are going to go up because natural gas is very expensive. And we could have problems with metals because you've got smelters and all these other things that use copious amounts of energy. And they're going to say, well, we can't afford to actually make the metals on some of this stuff because it's so expensive to melt it down and configure it to whatever configuration they want. So I think we're going to see a lot of dislocations coming. And I'm talking a couple years out, and they're just starting now. So that's where kind of I get a little bit worried is what's coming 2-3 years from now when a lot of these deficits kind of all hit at the same time. Deficits in a lot of the minerals. So I think
my question actually, maybe it's an interesting topic to touch upon, because I think that's actually the main risk of the thesis, because I share largely the same thesis. That's what's attracted me to commodity. All that I'm doing right now is commodities, with my own money is 100% in commodities. All that I do online is only commodity focused. I don't touch anything else right now because I share that same thesis. But one of my concerns is that there's too much, like the thesis is like, how should I describe it? Is it like it's too good? Like, I mean, what happens if smelters go out of business? What happens if ship makers go out of business? What happens if a lot of these companies start going out of business? Then you have banks who are not willing to lend that much money into existence, and then we go into a money deficit, if you will. I mean, available money to spend on stupid stuff, if you wanted, available money to spend on consumer stuff. And that's actually pushing us into a recession and probably further into a depression. So that's sort of when I start becoming sort of doomsday-y. And that's the main risk that I see for this thesis. So what do you think about that?
I think that has to happen, unfortunately, because if you can't raise the supply side, the only way you can do it is destroy the demand. That's it. And if you don't have the energy to do it, the demand has to be destroyed. And I mean, look at what we're doing. Just if you were to step back and look what we're doing across the entire world, we're blocking everyone from basically drilling for oil. And then the only way that we're trying to manipulate the price is by releasing strategic petroleum reserves. So that temporarily can fix it by accounting for, one inventory into another, but it doesn't fix the problem. And the problem is that we have an unstable energy source from renewables, which then increases the natural gas demand because you have to run natural gas as the transition fuel, which then impacts, natural gas and the pricing of natural gas, which then went into coal, which then is going to go into oil, which then blows on. It'll go to uranium next because they're going to start extending all of these nuclear power plants out. Really, it's just, they botched this transition very badly. And then the underinvestment in all the metals over time. So it's all kind of culminating, I would say, in a couple of years, in my opinion, for a massive bull market run. And I don't know how they're going to keep this from like really starting to rocket. Obviously, you saw nickel. We had some pretty large moves in nickel here recently, and they pulled back a little bit. But that's what's going to happen is you're going to see that across the board. You're going to see these big kind of surges in commodity prices. They'll kind of come back down, and people will point to the short term and say, hey, look, the commodity price came back down, like lumber. They'll say, hey, lumber came back down, but it's going to go back up because we need all of these minerals. It's not a function of I'll say this, I'll relate it to housing. A lot of people kind of, I think, understand housing better. They'll say that people can't afford because mortgage rates go up. Mortgage rates go up, they can't afford to buy the house. I said, well, okay, well, watch rent prices. So then rent prices go up like 50% year over year, like just massive increases of rent prices. I said, well, it didn't solve your problem of high mortgage rates doesn't build more new homes. You're not adding to the home stockpile, so to speak. So you still have these shortages in the market. And all you're doing is you're putting a floor underneath the market as it goes up, because all these people want to buy homes. They need homes. And we don't have the amount of homes in the system to satisfy that demand. The same thing happens with minerals. We want to use and we want to use all these minerals. We want to make all these new things that are highly complex, like electric vehicles and stuff like that. And I think we're going to run into a mineral tightness. And you're going to start seeing the first signs that you're going to start seeing is you're going to start seeing these big companies running for minerals. They're just going to start fighting for them. And the thing that I get scared of is if the imbalances get too large, that countries will just start nationalizing things. They'll just say, we're not going to, sorry. And I bet you're going to see that with, I think Mexico was doing it with lithium. You're just going to start to see nationalization. So that's why I'm a big physical metals guy, because the things that are in your hand that have great utility, like silver, that could be ultra valuable, and platinum. There's a bunch of uses for it. And if you have it in your hand, there's no risk of nationalization. There's no risk of a company messing something up or management messing something up. It's just a really low risk approach to play it.
That's right. Yeah. Especially that's why I like scrap silver and scrap gold, like small jewelry and stuff that like it's not non-monetary forms of physical metal is what I like. I don't have too much of it. I probably have too little of it. But now that we are speaking, you're making me think about it. What do you think though is the main risk for retail? I'd call them speculators, not investors, because when you're speculating on the shares, it's not the same type of investment as to what you like calling investment. But what is the main risk here? Timing, like timing the good, like the good place to exit, or what would you see the main risk being?
Well, for a new investor, I think their risks are they take on too much risk. So they want to pile into like exploration companies, like a whole bunch of money into exploration. And it's like, in my opinion, a lot of these, they're so low ore grade that stuff may never get extracted. And you're just playing and you're just speculating that money's going to rotate into some of, one or two or three of those companies that you own. So I think they're taking on like just too much risk, and you don't need to take on that much risk to make a lot of returns. And I think some of it, my viewpoint, isn't necessarily to try to make returns. It's to protect what you have already, because an environment that's coming, like, and I could be wrong here. I'm not trying to like push on the narrative of that we're gonna for surely have these big shortages. But if we do have shortages, if there's a resistance to growth through minerals and energy, the whole system's predicated on a larger future. So currencies exist because they can expand, but you can't expand into something where your GDP can't expand. It gets stuck. Like you got like a wall preventing you from increasing. And it's not just one mineral, it's like a whole bunch. So if you have that wall over there on the GDP side where we can't really grow it very quickly, and then we've got the expansionary phase or the expansion of the money supply that has to happen to basically keep debt levels manageable, you're now stuck in like this really, really high inflationary period where you're stuck on your GDP and what you can produce. And then they're just blowing out the inflation on the left-hand side of money creation. So that would then bode well for your physical metals, because if you can't produce the physical metals, I mean, you're just stuck there with the physical metal with low risk, and that could be a huge payout. Now, if things get really short, I think the risks are all like nationalization type stuff, or just massive taxes on these companies, depending on where they're located. Because right. I mean, I'm sure they're going to increase taxes on oil in America at some point, because they're going to say that they're making obscene profits, even though they need that to reinvest. But, I think it's just taxes and nationalization are your biggest risks, and then getting too much risk.
That would mean that you'd probably be freaked out if you see some of the speculations going on in some of these exploration companies that are in like South America. Let's talk Chile and Peru, because Peru has been talking a lot about nationalization. There have been blockades on the copper mines, on large copper mines. The farmers over there are getting sort of pissed off with the companies like, hey, copper prices have gone through the roof. You're making a lot of money, but then I have, bad weather and I cannot do like I have to. I even watched this documentary. Like some of these farmers have to move up a couple of kilometers up in the mountains so that they can get out their coffee basically and stuff like that. And they get pissed off. They push the government. There's coups and stuff like that. Those things actually happen over there, and they have happened in recent history as well. So I guess jurisdiction, that's a very good point when it comes down to speculating. I think jurisdiction could be one of those main risks, because some of these less politically stable countries, like, for example, in South America, but not only, there are other places too. Some of these countries I would imagine they would start toppling first. So I would imagine, you'd see a lot of tax increases and a lot of nationalization in some of these other countries, and then that might move over to the West. But that's a good point. Jurisdiction might be one of the main risks of a portfolio, because that's where you often find cheap stuff. And as a speculator, as an inexperienced speculator myself, that's what I'm attracted to. The things that you described is that I'm attracted to low market caps, early stage exploration companies that are cheap and are undervalued because of the value, because of the jurisdiction that they're based at. But that's actually the biggest risks. And at some point, it might not even be making sense in terms of risk reward as to what I'm doing. So that's you're making a good point. Thank you for that.
Yeah, so what I would say is the probability of getting a good return outweighs the overall potential return that you can get. So what new investors usually do is they look at, this thing could potentially give you 100 bagger or something like that. And I said, well, what if you knew that you could get like 2 or 3 or 4 or 5 times your money, but it was like a high probability that this was going to occur. It's like, go after the high probability stuff, get that return, and then go after something else that's high probability and then rotate it over. That's kind of where my thinking is of what's coming. You can play swing for the fence type moves, and I have some money in it. I just hope it works out for everyone, because if they start nationalizing stuff and you're swinging for the fence in the wrong areas, you're swinging for the fence in some of it, and let's say they even do hit, you better hope that they have the infrastructure to put in place whatever you're going to do, because I think there's going to be a premium on the physical things. If you're short oil and you can produce oil, that's great. But if you're an exploration company and you're not producing anything, I mean, maybe you're just taking on a little bit too much risk.
That's true. And I know people have started sort of disliking Rick Rule, but he's taught me a lot. He's one of the first people who started teaching me, and he always told me to build my life around probabilities and not possibilities. And it's only that's the most logical thing that you would do. Like, that's the reason why people go to work, because they know that there's a very high chance that they would get paid at the end of the month, because otherwise, why not just play the lottery like for one whole month? And because the possibilities, you win a couple of million and then your paycheck was a couple of million for 1 month, and like, that's great. But that's a possibility. Going to work, doing your job, there's a high probability you're going to get paid. So we are already doing it in our lives. Like, you build your you build your life around probabilities rather than possibilities. But it's interesting how, when you're starting out as a speculator, how you're tempted to go for the possibility, because you see these 100x possible returns. And so in my life, I would build my income around probability, but then my speculations, I would build them around possibility. So it's a weird concept to understand, but I think that once you understand it, you're on your way of becoming a more sophisticated speculator, I guess.
Yeah, the spots that you really want to look for are companies that are down, that have the infrastructure in place, but the commodity or whatever they sell, the service, is way down. And then, since everything's in place, there's low risk there. You're just betting on it coming back. That's all you're doing. You're just betting on the Baltic Dry Index coming back. You're betting on oil coming back, but all the infrastructure is already in place. Management's in place. The people are in place. So I would consider a leverage bet to what the commodity is going to do.
Mm-hmm.
And if you look at some of the sectors, some sectors they carry a lot more risk than others. So oil, I consider to be a really low risk sector, because they have everything in place. And if oil goes up, you make the money. It's a leverage bet on that oil producer. uranium doesn't have a lot of producing companies. So it's like you're really starting to go out on the risk curve to gain that return.
Mm-hmm.
They don't have the infrastructure in place. They don't have all that infrastructure there. So the returns can be so outsized there. They can. The possibility is so large that I think some exposure is warranted.
Mm-hmm.
Totally agree there. And I do think the future, I think we're going to have to go nuclear. Like I don't see a scenario where if they want to go with low emissions that you just totally omit nuclear. It doesn't make any sense to me. Like, I don't know if it's possible. Like, you can go 70-80% renewable if you can store electricity somehow through hydrogen or whatever. But I just don't see how they could set up a world where you have no baseload power. And I don't think baseload is going to come from natural gas or oil or anything like that. So it's probably going to be nuclear. And if we're going to go nuclear, we got to ramp nuclear up massively. So I think uranium's a really good bet. I just think it's great, but it does carry a lot more risk. That's all.
Again, as shameless as I am, I make my money through my website. It is what it is. So I'd encourage you to consider subscribing to that email list. It's completely free, and I don't send more than one email per week. All right. If you want, you can click on, if you're on your computer, there's probably a box or whatever somewhere here. And otherwise, there's going to be a link down in the description below. Okay. Thank you for watching, and have a great week.